Hello, welcome back. Inflation seems to be the topic of discussion for most of 2021 and 2022. And 2022 seems to be a year of investing that's focused on the outlook for inflation. So in this briefing, we're going to look at how the expectation for inflation and the values of the unexpected inflation is going to impact the returns of different asset classes, including bonds, equities, real estate, and gold. As of December 2021, Feds have signaled that they're going to raise rates at least 3 times, with the earliest raise expected in March, paving the way for 0.75% rate hike by the end of 2022. Bank of Canada is expected to raise rates before the U.S. Fed's keeping inflation target at 2%, with Canadian inflation expectation remaining high at 4.7% in the near term. Bank of England has raised its key interest rates to 0.5%, saying its expected annual inflation to accelerate above 7% within months. European Central Bank is expected to follow suit shortly. The spread between the 10-year Treasury yields and the TIPS rate, which is a proxy for expected inflation, stood at 2.48% as of January 31st, 2022. Looking at the yield curve, yields moved all over the place, and as we see, the short-dated Treasury rates increased more than the longer-term Treasury rates. Interest rates rose across all maturities, but more on the shorter end of the curve, with the lower maturities than the longer end of the curve. Higher maturity Treasury bonds, such as 30-year, we see that it increased by only 17%, while one-year Treasury rate increased by 440%. So if we look at the spread between the Treasury yields, the 30 and the 10-year yield is showing a downward sloping yield curve, while the other two, the 10 and the 3 months and the 10 and the 1 year, is moving all over the place. Now let's move on to inflation. Inflation will determine much of investing methodologies and stock selection decisions in 2022. And the outlook for inflation and the expectation of how it will play out throughout 2022 will impact asset allocation decisions. Inflation can be measured in a variety of ways. It can be measured by looking at the CPI data, PPI data, or GDP deflator. All measures have pointed to heightened inflation throughout 2021 and into 2022. It all depends on the basket of goods we look at. The expectation for inflation, however, will derive many investment decisions this year in 2022. It can be determined in a variety of ways by looking at surveys, the spread between the Treasury yield and the TIPS rate. But the expected inflation is predictable, and it can be integrated into the stock selection and asset allocation decisions. It is the unexpected inflation that is going to be difficult to predict and will impact investors and businesses with or without pricing power and asset classes. And in this study, we're going to look at the impact of unexpected inflation on asset returns. Let's look at financial assets, which includes equities and bonds in this case. And we look at the S&P 500, the average returns over quintiles of unexpected inflation. Unexpected inflation in this case is determined as a differential between the actual inflation and the average inflation over the last 10 years. And when we're looking at the returns of the S&P 500 on a nominal and real basis, it's clear that during periods when the inflation is less than the expected inflation, or when the unexpected inflation is lower, returns have been higher. And when we looked at the corporate bond returns, the Moody's Season A, AAA, and Baa with corporate bond yields, you can see the yields are higher when the inflation is less than expected. And it's clearly shown this trend that when unexpected inflation is much higher, the financial asset returns are going to diminish. Now looking at the impact of inflation on size and value and growth factors. Looking at the impact of unexpected inflation over the last 65 years on small cap and large cap returns, determined by the Ibbotson SPBI US small cap stock return versus the large cap total return. We take the differential of the two. And also we're looking at the lowest deciles of price to book returns. And in this case, that's the stocks that have low price to book. We're breaking down the price to book of the assets of the different equities in the North American market into 10 deciles. And we're taking the differential between the lowest deciles of price to book and the highest deciles of price to book. It's clear that the returns have been much higher when inflation is more than expected for both the small cap plus large cap and also the low price to book minus the high price to book returns, which represents the return of the small cap premium, and small caps have performed better when inflation is higher than expected, and value stocks and low price to book or even price to earnings stocks perform better when inflation is higher than expected. Now let's move on to the impact of inflation on gold, commodities, and real assets such as real estate. In this table, we're seeing the average nominal gold return represented by the net change in gold prices on an annual basis over the last 52 years. We can see that gold returns have done much better both on a real and nominal basis when inflation is higher than expected. And looking at real estate returns, the real in a real term, on a real basis, represented by real home prices and the net change of home prices over the last 52 years, we can see that returns have remained relatively flat. So it hadn't really changed, but gold represents a great opportunity as a best hedge against unexpected inflation. And we can see in this graph that really real estate haven't shown many real, on a real basis, represented by real home price index return, haven't shown a pattern. But gold has clearly shown stellar returns when inflation is higher than expected. So what's the outcome for 2022? If the outlook for 2022 inflation is to remain high with actual values above the expected values and for high inflation to persist throughout 2022, asset allocation should shift away from financial assets and into gold and real assets. Equity allocation should shift towards small caps, low price to book, low price to earnings ratios, and companies with more pricing power. However, if inflation is expected to revert back to long-term averages, like much of 2021, large cap high growth stocks are expected to outperform despite their high valuation.